Have you ever bought something now but paid for it later? Businesses do this all the time. And in accounting, that unpaid amount is called accounts payable, or AP. Accounts payable is money a business owes to suppliers or vendors for goods or services it has already received but hasn't paid for yet. In simple terms, it's unpaid business bills. Think of it like buying on credit. For example, imagine a business orders £5,000 worth of inventory from a supplier. The supplier delivers the goods today but gives the business 30 days to pay. The business now owes £5,000 and that amount becomes accounts payable. Now, why is this important? Because accounts payable is a liability. It represents money leaving the business in the future, so it must be tracked carefully. If businesses fail to manage accounts payable properly, they can run into cash flow problems, damage supplier relationships, or late payment penalties. Now let's look at how AP is recorded. When the business receives the goods, it records two things. First, it records the asset or expense it received. Second, it records accounts payable because the payment is still owed. Here's a simplified version. The business buys £5,000 of inventory on credit. Inventory increases by £5,000. Accounts payable also increases by £5,000. Assets increase, its liabilities increase. Then later, when the business pays the supplier, cash decreases and accounts payable decreases. That means the debt is cleared. Now, why do businesses use accounts payable instead of paying immediately? Because it helps manage cash flow. Businesses can receive products, sell them, and sometimes even earn money before the payment is due. This flexibility is a major part of how companies operate efficiently. But here's something important. Accounts payable is not the same as accounts receivable. Accounts payable is money the business owes. Accounts receivable is money customers owe the business. People mix these up all the time. Another common misunderstanding is thinking AP is a bad thing. It's not. Healthy businesses regularly use accounts payable as part of normal operations. Problems only arise when payments become unmanageable or overdue. So, what's the key takeaway? Accounts payable is money a business owes for goods or services received on credit. It's recorded as a liability and plays a major role in managing cash flow and supplier relationships. And once you understand accounts payable, you begin to see how businesses constantly balance what they owe, and when money actually moves.